Okay, Holly, right. So this is the next question, and 152 hurling. So it says a couple of issues here, just so that we go through it. So when you're reviewing this, your audit supervisor of caving, listed company, risks everywhere, literally everywhere. You manufacture computer components. This is not a new client. It's listed though. So because the company is listed, one, there must be certain, they must follow certain procedures they must satisfy, not just for financial reporting, but also for the Securities Exchange Commission because they're also listed. So they must have good corporate governance, so they must have non-executive directors, a good balance, a good mix. If you like, they must have remuneration committees, nomination committees. So all these sort of things. Once you see this, you're thinking, okay, do they have this? In terms of us, we must have what we was referred to as a cold review, a hot review. We must have a second partner who will look through our audit work, if you like, to make sure that we have gone through, if you like, we have done the audit to the best of our knowledge. It's almost like quality, but because it's listed, we must have that. There's increased risk of giving the wrong opinion. Okay, great. So let's look at what these people are doing. They make the things, sell through wholesalers, and also their own website. They recently upgraded their website. So now straight away you're thinking, okay, I mean, there's risks everywhere. We'll go through yours in a second. They recently upgraded their website. So the question here is, this thing, when I go debit website, credit, bank, or whatever, however I've done it, is the website, have I correctly recognized that website in my financial statements? It's an asset, if you like, as opposed to a full-on expense, so be careful. Additionally, the company entered a transaction to buy a new warehouse, which will cost this. Okay, great. So it says they entered a new transaction. They're working to ensure the legal is completed. So the question is, have they recognized this as well? You can't recognize it yet because the warehouse hasn't quite transferred over to you. Transaction isn't quite complete. It says they issued 5 million of irredeemable preference shares. So we also need to make sure this has been correctly recognized. So debit bank, it's irredeemable. So because they're irredeemable, these are equity, right? So you don't have to pay this money back. Because it's irredeemable, you're not going to pay it back. You're going to be giving this preference dividend, if you like, for the life of the preference share. So the question is, has this been recognized under equity or has it been recognized under liability? It should be recognized under equity, right? So you can see, I mean, I could go on. Literally, here he's gone along and increased the useful economic life. Why? So all our responses are about things we should do. Remember, we're planning. We're planning. So we're going to say, okay, listen, Oyeni, when you go in, you're going to, if you like, assess this the life of these assets to see what's going on here. So all our responses about what we should do, things we're going to be doing, because we're pretty much the client has passed preconditions, so they do prepare according to financial reporting frameworks. We've accepted this client. It's not like we're doing this before we accept the client. We're just sort of making sure when we go in there we're planned, right? This is all about planning, knowing exactly what we're going to do and focus on, and sort of what procedures we're going to be carrying on. So the question is not asking you to carry out the procedure per se. It's just saying, what procedure are you going to be doing? What are you as the auditor, what are you going to be doing? Okay, great. And so you have here, they've revised that credit period, what's going on, experienced difficulties paying, and then they've done this new bonus thing here, significant. So yes, sales have gone up, but straight away we're looking at trade receivables. So we're going to be doing cutoff testing, like you wrote earlier in one of your questions. We're going to be asking, how quickly is this money, this extra sale we've done, how quickly is it coming back? And that's cutoff testing. So the best cutoff test in the world is after date, cash coming in. How quickly is the money coming in? You can't go wrong with that as a cutoff test. How quickly is the money coming in? And if the money's coming in 6 months later, then we know there are issues here. So we then have your kind of your liability issues, and these are nice questions. This particular one here, where it's you've got all this inventory, for example, for this product, and the product's not selling, so we probably have to slash the price or take it down to its written off scrap value. Probably it says legal action, so we have to be thinking about potential provision. Contingent liability, potential provision. We need to be investigating, speaking to the lawyers. What's going on with this thing? Are we going to get sued? Do we need to be putting the provision? Prudence requires us to do that. And then there's some NEC, NED here. We'll look at your answers here. I'm sure when you review this, they want us to bring in one of our own engagement quality control reviewers. So this is the person who I said was going to be looking at the accounts a second time. They want them to come and work for them. That can't quite work. That's too close. And he's recommended the audit fee should be based on the profit before tax. That's just absolutely wrong, and that should never happen. You know, it's our work. It has nothing to do with their profits. They still owe us. So technically, we should stop doing work for them until they have paid us, right? So lots of stuff here, and then it says describe 8 audit risks, which is what we're going to go through, and ethical threats. So let's look at your answers quickly. And actually, let's raise their answers as well, to see what's going on. So let's look at what the examiner is saying, because this is what this review is really saying. It says, it's disappointing we're unable to answer the knowledge marks, so many people scored 0. So the knowledge mark was about audit risk, ultimately. It says here, listen, please, listen, watch this. Audit responses still continue to be weak, and while an auditor's response does not have to be a detailed audit procedure, rather an approach the audit team will take to address the identified risk. So sometimes it's a bit vague. Discuss with the discuss. No, I think that there has to be a bit more. Candidates continue to concentrate on what managers should do rather than the auditor. So it's very much, it's a bit of, I mean, I would almost dare say, do some testing. You know, when I say you just basically write out what test you would do. You're not doing the test. Just say, this is the test I'm going to do. Right? Think of that like that. This is the test I'm going to do. Okay, great. So let us see. So audit risk. So let's look at your answer. So always take. Sorry. Great. Audit risk. Yes. Audit risk. Is the risk that the auditor might might give an inappropriate opinion based on material. Yes. This times this times this. Control risk occurs when, yes, inherent risk is the error due to the failure. No, inherent risk is not. Well, yes, but inherent risk. Yeah, so this bit you need to get. So this bit isn't. Yeah, we won't be happy with this bit. We'll sort of say that this bit needs work. This question of risk. So you're right. Audit risk is composed. Audit risk is the risk that we will give an inappropriate opinion. So I'll take that. We will give the wrong opinion. It's not even about whether it's we will give. It's just that you're right. It's the fact that it's inappropriate. So we're giving the wrong opinion, if you like, and due to, if you, well, this composition of control, inherent, and you don't really have to put the times, but you can just discuss the fact that it's made up of all three. Now, the first risk you want to talk about isn't control risk. The first risk you want to talk about is inherent risk. Now, inherent risk is due to the nature of the business. Yes, due to the nature of the business, due to the nature of the industry. There's just nothing you can do. Now, what does that mean? Say, for example, there's a risk that inventory will always be fluctuating or overvalued. Well, just because of the nature of that industry, we might, if you like, end up saying that inventory is a certain number when it really isn't. And we end up giving an inappropriate opinion. So, because the nature of that industry is where you have inventory constantly fluctuate. Or you might have, yes, you might have an overbearing boss who continues to ignore all the rules, and so controls are not put in place. So as a result, if you like, control risk is increased. Um, or you will have a scenario where there's a lot of cash flowing around. The nature of the business is a lot of cash, so as a result of that, there tends to be probably some degree of theft, and so we can't quite be sure. We can't be sure about, well, the nature of industry allows theft. And so the argument really here is that inherent risks are risks that are industry based risks, and these increase the likelihood that we will give the wrong opinion. Control risk, yes, you're right, is that as a result of there not being sufficient controls in place, that we will give the wrong opinion. So, not that you're not right about the fact that there's sufficient internal controls, is just that the controls in place will not prevent. Oh yes, good. Will not prevent material misstatement from happening. So there is some, yeah. This one maybe I was a bit, maybe it was inherent risk, and detection risk when good. Yes, good. So this is detection risk is more about us, but I think your framing is slightly weak. But you have the right ideas. So what we need to do is we need to make it sound exactly like the examiner. This is really critical. So like I said, this is the first bit. I think you have this. Um, and if you remember, we broke down audit risk. We've done this repeatedly. So, audit risk is made up of two components: the risk of material misstatement, and you want to write this, the risk of material misstatement, and detection risk. The risk of material misstatement is made up of inherent and control. So, when you go back now and do this again, you just want to make sure you have this fixed in your mind. So, inherent risk is again, like we said here, um, before we think about any related controls, you can discuss it in terms of the nature of the industry, the nature of the environment. Before we talk about anything, it was always going to be there. And then the control risk is the risk that um, will be. You're right that the internal controls will not prevent, detect, or correct a potential error. And so, but let's get the language. Let's get into the language. This idea of an assertion, I talked about it a lot. What is an assertion? Someone says that. So we have the ACCA cover. Someone says that, for example, non-current assets, buildings, 5 million. So someone is saying when you see 5 million on a statement of financial position, the directors are saying this figure is accurate, it is complete, that is the right value, it is correctly classified. Those are assertions. So the argument is that those assertions are suspect, because either that what this now means is that what we're really attacking are those assertions. That's what we're testing, those assertions. So there is a susceptibility of an assertion about a class of transaction, blah blah blah. It could be material before. So it's all about the assertions. The risk could occur an assertion about a class of transaction or account balance or disclosure. So we'll come to talk about this. Really, please, I hope you're watching this. Class of transaction, this is in the income statement. Account balance, this is in the balance sheet. Disclosure, these are my notes. So these three ideas you must put into your vocabulary when doing your audit exam. These are the three things you can see here again: class of transaction, account balance, disclosure. And so you become in tune with the marker. He knows that you've actually got your language right. And detection risk is the risk that you won't pick it up because of your bad testing, which is based on sampling or non-sampling. You must write this as well. So sampling is a case where we have sampling risk, where you have, if you like, where you have a situation where you have picked a sample, and sometimes you might be unlucky, if you like, and picked you've picked the wrong sample. It's not your fault. And so you can have that. That's a sampling risk. It's just what it is. And you can have just non-sampling risk. So you've just been a bad auditor. You've just gone in there and done a bad test. You haven't tested the right thing. You haven't tested the relevant things. Just a bad auditor here. But sampling risk is you actually went along and you had a go. You said you did a random sample, and from 10 invoices you wanted to pick two. You picked two, and the two you picked happened to be right, but the other eight were wrong. So you're given the wrong view based on just chance, and ensuring that you picked two invoices that were both authorized, but the other eight aren't. So the opinion is that overall that thing isn't authorized. And here they just go through all the responses. right? So much we could talk about here, but let's go to your answers and see how you fared with hurling. Um, Good. Yes, good. So good, 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 good. Assess this capital register. Very good. You should new purchase. Yes, good. They should make sure it's not been entered. So you're assessing the sale, and again, like I say, you should kind of you can you can talk about what you're going to do. You say review the fixed asset register to ensure, right, that that asset will not be in there. Good. Yeah. So you almost want to actually tell us exactly you have, but tell us what book you're going to be looking in as well, so the examiner can see that you are actually telling him what to do, so he doesn't think you're just being general. So again here, good. Yes, good. Assess the fixed assets by looking at the fixed asset register. Actually do some testing or carry out what's referred to as a proof in not proof in total, I suppose. Actually for yourself, and look at the life. And the best way the best thing for this time, one just ends up talking so much about this. The best thing way of looking at this is to always say, if someone says something is going to last 3 to 4 years, we just ask, okay, let's see how quickly you're selling your asset. If they're selling the assets every 2 years, then we know this is not true. So we question, we have a look. That's the best way. We look at the fixed asset register and we say, how soon have you sold these assets? How soon have you sold these assets? Right. So here again, yes, good. This is there, and allows us to discuss with them. There's this discussion, and you can actually assess. So, um, so let's look at how they're framing this, so that you can, so we want to sound like them. So this is this thing here: discuss with management, inspect legal documents of ownership, such as title deeds. So the key point is we're doing our best. We're actually doing something. It's almost like gentle testing, what we would do. Um, Here, let's go back. This is the one I'm interested in. This discuss with the rational. Also compare how, like I said, how often the assets are replaced. This is what review the credit terms and identify if any after date cash receipts, right? And like you said, make an allowance. So very clear actual tests are being done here. I would have, I probably, I was thinking maybe do some sort of ratio analysis just to see if they're struggling in terms of this is the business itself, to see whether they're in terms of covenants as a result of this lack of cash. But then let's go back to your answers. So assist, yes, good. Yes, good, good, good. So this was this assess the cutoff for sales, ensuring they relate to the correct period. Correct, very good, very good, very good, very good. That was good. Yes, and ensure the journals are so they're included in the prior year. Are made so they're included in the prior year. Yes, good. So let's just look at how they've tackled this question of cutoff. Um, yes, here we are. Good. Yes, that's right. You're correct. That's sort of increased sales cutoff testing. So they haven't said too much. They've just said just carry out some sales cutoff testing. They haven't actually said what we're going to do. And we, of course, cutoff testing also. Remember, I talked a lot about there is cutoff, sales cutoff, but we must also talk about sales returns. So if sales returns are if you sold goods in December and the goods were returned in January, those returns relate to December sales. So you need to bring those returns into December, right? Because they relate to December. So where was I? So I think overall, let's just go back to your answers and then do the flick through the rest of those. Um, right. Yes, here we are. Yeah, you've written quite a lot. Good there. So that's all very good. Timescale should be discussed. Yes, good. And maybe we could come in very good and do an internal very good. You're there. Um, Discuss and come up with a payment plan. Very good. Or maybe you say, well, we can't kind of continue carrying out the work. Um, Yes, very good, because this is a listed company. Really good, really good. I think you're I'm happy with this. So please, yes, let's look at the NED business here. Um, yes, let's see. No, sorry, there's a yes, good, good. Yes, very good. Those are good. The partner should not be involved for another 2 years. So good. Come up with a payment plan. So yes, I think yeah, I'm happier with this one. This one, I think this was out of 16. So I think definitely you're on that. You could get 10 out of 16 here, and maybe you could have gotten um maybe say 2 out of 4. So we're 12 out of 20. So this is a stronger outing. So again, as usual, what you want to do is flick through those answers in the because there's so many risks we could go. I think we only wanted 8, right? So you could go on, but you want it's your response. Your responses are the key issues there. You want to make sure are as close as possible to the mark scheme. So just breeze through them again as you're doing your work. Okay, great stuff. Let's move on to the next one.